take a look if you have questions about how any of the quiz questions were worked. Okay, so this is off of Canvas. Okay, and if you brought your computer, you could probably see it there. If not, and you didn't print it, you can just follow along here. And then if you want to sort of compare this and watch this video again later, you can do that as well. Okay, so let's just go ahead and let's take a look at this first one. And we have this bakery, and they're telling us what their revenues are. Revenues are reported where? Income statement or balance sheet? Okay, that's going to be reported on my income statement, right? And my expenses are also going to report on my income statement as I derive my net income, right? So they give me revenues, expenses. They tell me the dividends that are paid. Now, dividends are going to be reported on the statement of retained earnings, aren't they? Okay, as I pay those out of my retained earnings. And then this question had a little bit of a wrinkle in there, and that they sit there and they ask you, what is the amount of stockholders' equity? So you're sitting there saying, well, they give me all the tools to answer something about retained earnings, and then the question makes a turn on me here and says, well, tell me about stockholders' equity. So you'd have to sit there and say, well, look, I got to answer this question, and I know that my stockholders' equity consists of what? What are the two accounts? Two accounts of stockholders' equity? Okay, common stock, okay, and what? Retained earnings. So it must be that I'm going to have to sit here and analyze retained earnings to be able to answer this question, because they don't tell me anything about common stock, do they? So I can't sit there and figure in any factors for common stock on this. So the way I would set this up, I would just go ahead and set it up beginning balance. What are the adds to the accounts? What are the subtracts from the account? And they're asking me here, the unknown is this ending balance, isn't it? Okay, so if they just started operations, what's the beginning balance? Beginning balance and retained earnings is 0. I haven't had a chance to retain any earnings, right? I just started this company. Good. I know that the add is going to be net income, isn't it? Okay, so what I would do is I would go off to the side and calculate my net income. And so my net income is going to be my revenues, right? How much were my revenues? 60,000. Good. Minus my expenses. How much are my expenses? 35,000. Good. That difference is going to be what? 25,000? So my net income ends up being $25,000, doesn't it? Well, that's an add to my retained earnings, right? I'm going to retain my earnings, so I'm going to add that in, 25,000. With me so far? Yeah. Okay. Then what? When I pay the dividend, I pay that dividend what? Out of my stockholders' equity, or excuse me, my retained earnings, but they're making me analyze stockholders' equity here, the way they asked me this question. But it's paid out of my retained earnings, right? So that's a subtract of $20,000. So the ending balance in my retained earnings after I've paid out that dividend must be this $5,000, right? Okay, now they're calling this a $5,000 credit here, and all that is saying to me is what? Well, there was a 0 beginning balance. The difference is revenue a debit or a credit? Is revenue a debit or a credit? Revenue is a credit. Okay, when I have revenue, I do what? I debit cash, say, for, what is it, 60,000? And I credit what? Revenue. If I have revenue for 60,000, right? Right? Okay, if I have expenses, what do? I debit my expense. What was it? 35,000 here? And I credit my cash. Just trying to write that in somewhere where it doesn't make a mess, but I guess it does make a mess. Credit cash for 25,000, right? So revenue is a credit, expense is a debit, isn't it? Okay. Okay. How much? 35,000. Credit my cash, 35,000. Thank you. And so if revenue is a credit and expense is a debit, then my net income must be 25,000, that means my credits were more than my debits, weren't they? Okay, and so what happens, at least, I mean, debits equal credits, but at least the ones that affect the income statement, the credits were more, and so that's a credit. Dividend is a debit, isn't it? When I debit the dividend, and so the net impact of this is a $5,000 credit, isn't it? Okay. All right, good. September 2nd, promise ring, reported stockholders' equity of $156,000 during the month. They generated revenues, and they start to read through this, but let's just look. Again, we're asking you stockholders' equity. Stockholders' equity is made up of what two accounts? Retained earnings and common stock. They're not telling me anything about common stock here, so I know I'm going to have to analyze retained earnings even though we're asking about stockholders' equity. And so what happens? I would do the same thing, beginning balance, add, subtract, ending balance. What's the beginning balance here? They had 156,000 at September 1st. Since they're asking me the end of the month, September 30th, the beginning balance is 156,000, even though I'm just analyzing retained earnings here, right? Okay. Then what happens? Then I have to add. What's my add to my retained earnings, everybody? What do we call that? Everybody? The add to my retained earnings is net income, so I go ahead and I take the revenue. Revenue is what? 38,000 minus my expenses. Expenses are 21,000. That means I have a net income sitting here of what? 17,000. Thank you. Okay, so I go ahead and I add in my net income, 17,000. The subtract would be dividends. Do they have any dividends? They paid dividends of 2,000, didn't they? So I subtract out the dividend. That gives me an ending balance here of the 171. Is that the ending balance? Okay. What about the purchase of the equipment? The equipment is no impact on my retained earnings, right? Okay, if I purchase that for cash, it's going to be, and remember, if you looked at that connect exercise I was showing you, hey, there's sometimes where we make a transaction affects entirely the balance sheet. One asset, cash, goes down. Another asset, cash, goes up. Has no impact on retained earnings at all, right? If I had borrowed money for this equipment, my asset would have gone up equipment, but my liability also would have gone up. My accounting equation would have stayed in balance, right? There is no stockholders' equity / in this example, retained earnings impact for the purchase of equipment. Okay? All right, good. Let's go ahead and let's take a look at this next one. And I received cash of $700 from a customer. When I receive cash from a customer, well, let's set this up. I provide the service, don't I? And if I provide the service, should I recognize the revenue? If I provide the service, I can recognize the revenue, so I'm going to credit revenue for $700, right? Okay. Now what happens? The person doesn't pay me right away. Should I not take the revenue if they don't pay me yet? They tell me, hey, I'll pay you later. Should I not take the revenue? It's still revenue because I've provided the service, haven't I? Okay, so I can't debit cash, but I debit what? Accounts receivable for $700. I'm going to receive that money later, right? Accounts receivable is an asset, isn't it? Okay, so then what happens? Then the person goes ahead and pays me, and they pay me $700. Cash received. Oh, great. I showed you the wrong transaction, though. So never mind everything I just said. I misread that. It's what? Received a cash advance from a customer. If I receive cash advance, someone is providing me the cash what? In advance of providing the service, right? Okay, so if that's the case, what happens? Obviously, I'm going to debit cash because I'm receiving cash for $700. I have to credit something, don't I? I credit a liability called unearned revenue because what? If I don't pay the person, am I going to have to pay them back? Right? So I'm going to have unearned revenue of $700 here, and if I have to pay the person back, I will, right? Okay. So what? Only assets increased $700 here. My stockholders' equity didn't increase because I haven't provided any service yet. There's no revenue there. My liabilities didn't decrease. My liability did what? It increased, didn't it? Okay. Assets and stockholders' equity increased by 7. Stockholders' equity wasn't affected at all, was it? Right? Okay. What happens when the person, now I provide the service? What should I do? I go ahead and I provide the person the service now. Can I recognize that revenue? So if I provide the service, I go ahead and I credit revenue for $700. I have to debit something, don't I? What do I debit? The unearned revenue. Good, because I've now provided that service, right? That says unearned. I'm just going to debit the unearned. I'm just call it unearned rather than call out the revenue. I debit the unearned revenue. Okay. Okay, good. Now come over and take a look at this next one. And now we've got this Sebastian Bella, whatever, has performed services for $2,000 for CPA services, okay, for a client. But at the end of the year, they hadn't billed the client yet, and now they're going to go ahead and bill them. Okay, so we're going to have to make an adjustment to the financial statements. That's what we mean by an adjusting entry, meaning we're kind of catching up and cleaning up for things that had happened during the month or during the year, and now we're catching them up at the end of the year. We're adjusting the accounts. So if I provided the service, can I recognize the revenue? If I provide the service, I can recognize the revenue. So I know I've got to credit revenue, what, $2,000 in this example? I have to debit something, don't I? The debit's got to go to accounts receivable because I haven't received the cash yet, but I will soon, right? Hopefully this person will pay me, right? And I'll receive that cash soon, $2,000. I set that up as a receivable. So important takeaway. Notice that the cash does not drive the recognition of revenue. It's what? The performance of the service, isn't it? Just like up here, we got the cash in advance. We got the $700 in advance, but that didn't drive the recognition of the revenue. It was when we had finally got around and provided the service that we took the revenue. So cash does not drive what we do. It's the activity. Are we providing the service or not, right? Okay. Okay, good. Now, what happened? So we debited the accounts receivable, we credited service revenue. There's that entry right there. And then it turns out that a little bit later, she goes ahead and gets paid. The person pays her the cash, right? Let's say they pay her the whole, let's say they pay her $1,500. We don't have to make it the whole amount. Let's say they pay her $1,500. What's the amount of cash then? $1,500. I debit cash $1,500. What do you want me to credit? I'm going to credit the accounts receivable now because what? I've received that money. Okay, and if you watch that video on that connect problem, that's where I was going nuts because the balance sheet that they provided us never showed accounts receivable. So we set up the accounts receivable. When I tried to go over to the balance sheet and find it, it wasn't there. And the reason it wasn't there is because the book contemplated that they were going to have you in that same problem do what? Receive the cash. That would have made the accounts receivable 0. That's why I couldn't find it there because of the way the book set it up. It's not a real general ledger system. In a real general ledger system, they would put the receivable there. It would hang there until what? Until we received the money. Then it would disappear off. Okay? Okay, good. Come over and let's take a look at this one. Froggie Company. Okay? And Froggie Company has their first year of operations with revenue, expenses. So what should happen to the retained earnings? You can usually tell if I made up the problem if the name is Froggie or Buster's, and the question is real easy. Okay, so if I have my revenue, how much? 200,000. I have my expenses, how much? 70,000. My net income is 130,000. I don't know if I can give you an easy question like that on the midterm. Okay. Question? Yes, sir. hmm I'm just saying that they had 2,000 of account receivable and they collected 1,500, right? Yeah, number 4, they had a receivable of 2,000, and I'm just, kind of making it up as I go along here. They collected 1,500 of it, right? How much is still owed to them? Huh? 500, right? Okay. And what would happen? That's what accounting's all about. I would sit there and the reason we have this whole stupid process is I would sit here and I would have this accounts receivable up here, and I'm just showing you the way the ledger accounts look. And I would have originally done what? Debited it for 2,000. What do we call that when I go from the general journal to the ledger? Good. I'm going to post it. Very good. I post it. That gives me a balance here of what? 2,000? Right? That says 2,000, a balance. And then I went ahead and I credited it 1,500 when they pay me 1,500, right? And so now the balance is how much? The balance is how much now? 500. Okay? So what happens? If somebody calls and says, "Hey, Sebastian Bell, how much do I owe you now?" She can press a button and say, 500, please, right? It's sitting right there at any point in time, right? Or she can resend another bill with the new balance if somebody doesn't pay her or something, right? Okay? Okay, good. Come over and let's take a look at this next one. Froggy Company collects $120,000 on June 30th, 2015 for monthly services to be rendered between July 1st and June 30th, 2016. How many months is that? That's 12 months, isn't it? It's a fiscal year period, but it's 12 months. Okay, and they give him how much? 120,000. If I'm going to be providing services over that 12-month period, that means that's $10,000 a month, isn't it? Okay, even I can handle that one in my head. $10,000 a month. Okay, good. On July 1st, 2015, which of the following best describes the impact for this transaction on Froggy's financial statements? Well, just let's think about this first. If they've provided, let's go through the whole process. When they give this 120,000 on June 30th, what journal entry should we make when we receive this 120,000? When we receive cash, what journal entry should we make? Debit cash. 120,000, good. And credit what did I hear? Unearned revenue, because at June 30th, I haven't provided any service yet, right? Credit unearned revenue for 120,000, right? Because he hasn't earned any of that revenue yet. That's at June 30th. 6:30. Okay, good. Now, what happens when he provides service now in July? On July 1st, which of the following best describes the impact? Have we had a situation where if we got the money on June 30th, by July 1st, assets and liabilities have increased? Cash increased? Unearned revenue increased? Right? Assets increased, unearned revenue increased? Okay, by this 120,000. Now, what if, I think the next question actually is what does this. I say using the same facts, what impact will providing the service have on Froggy's financial statements? So let's say now at July 31st, I've provided 1 month of service, haven't I? So I've earned that 1 month of service, so I'm going to do what? Can I credit revenue for 10,000 now? Because I've provided that service for 1 month. And can I debit what? Unearned? Unearned revenue of 10,000? Right? right? What's the balance in the unearned revenue account? The balance in the unearned revenue, when I first got the money, it was a credit of $120,000. That gave me a balance of $120,000. And then I just went ahead and did what? Debited it $10,000, didn't I? So there's $110,000 left in the unearned revenue account now. Okay. How many more months of service do I have to give them now? I have to give them 11 more months of service. 110,000 divided by the 11 months I have left still comes out to the 10,000 a month that I'm going to be providing, right? That was 1 month. Okay. Okay, good. So you in the back there, when I make the next month's journal entry, August 30th, what should I do? August 31st, whatever. So August 31st has come by now, which... Okay. When I have revenue, I credit it, don't I, to increase it? When you have revenue to okay, do we have this slide down now? Okay, so if he's earned revenue, I'm not going to debit revenue. I'm going to do what? I'm going to credit revenue to increase the revenue, right? Okay. Okay, good. So I'm going to come back then to this problem, and I'm going to ask the question again. What should I do on August 30th when we have received, when we have earned that next month's revenue? Huh? Credit. Good. I'm going to credit the revenue, 10,000. And I can now reduce that liability by debiting the unearned, can't I? For 10,000? Now the liability is what? 100,000 that's left in there, and that 100,000 that's left now is representing the 10 months of service I have left, 10,000 a month, right? And it'll just keep going like that. Okay, so if it's 10,000 a month, if I know that through my calculation that I had made up here that we're dealing with 10,000 a month, what if I asked you what is the revenue that they should record for the year ending December 31st? How many months is that? Sign the contract on June 30th to provide service in July, August, September, October, November. That's 6 months of service that we were going to provide, right? So in that situation, we would have done what on December 31st? Debited the unearned for how much? Good, 60,000, the 6 months of service. Credit revenue for 60,000, right? Right? 10,000 a month, 6 months. Okay. Okay, good. So the answer to this question is when I provide the service, liabilities, unearned revenue decreases, and revenue got to increase, right? Does that recognize that revenue? Okay. Okay, good. Come over. Froggy purchased a building for $1.2 million, but I did not have the cash to purchase the building, but the seller said they would take $1 million cash down payment and that I could pay the $200,000 balance for the next 2 years. Okay, so what's going to happen here now? Well, am I going to get a building for $1.2 million? Yes. Am I getting a building for $1.2 million? So that means that I have to debit building for how much? $1,200,000. Good. I have to credit my cash. I'm giving up the cash as a down payment, right? So I have to credit cash for $1 million. Do I need a debit or a credit to make this journal entry balance? Not a trick question. Do I need a debit or a credit to make this journal entry balance? Not a not a trick question, huh? I need a credit of 200,000 to make this journal entry balance, and that credit is going to be to payable, isn't it? Because I have to pay a bill later. Get it? Pay a bill, a liability. I have to pay the person later. That's a liability, isn't it? Okay. So as a result of the transaction, what happened? Well, is cash an asset? Cash went down $1 million, but building, is that an asset? Went up 200,000, right? So the assets increased 200,000, as did what? As did the liabilities increase. The credit increased 200,000. If I'm telling you assets increased 200,000, I have only two choices. Either my liabilities increased or my stockholders' equity increased, right? This was a liability increasing. Does this transaction sound familiar? This is right off of the little example. I mean, the little, I don't know if we call it the little example. Maybe we should call it the big example. Where are you, example? The in-class example right here, which I showed you a little bit earlier. That was that same transaction right here. If we just want to see how it gets posted through the financial statements now. We had what? We had cash that we bought a building, I should say, for $1.2 million. Where's my building? There's the debit to my building as I post it. I credit the cash, what? Credit the cash $1 million, so my cash went down, but my building came up, so my assets went up 200,000. To keep assets equal liabilities in balance, I needed to do what? Increase either my liabilities or my stockholders' equity. That was a liability because it was a pay-a-bill, right? I have to pay this person later. Okay, so that was that same exact transaction, and all I did was turn it into a little, fact pattern. All right? Okay, good. How about March 1st, Mudhoney purchased equipment for $30,000. The company's depreciating the equipment at a rate of $500 per month. At January 31st, 2015, accumulated depreciation is it's $500. I'm just not sure that we're ready for this at this point. Hold off on this. Okay, we're going to look at something in chapter 3, and we'll just hold off. Wait for a second, and I'll explain it to you later. Okay, I'll explain this to you better once we've had more time to look at this. Okay, so we'll get into that. If you understand already, that's fine, but we'll get more into it. Okay, all right. Now we look at this number 12, and we see that we have this Fugazi company, revenues, expenses, and I'm asking you to go ahead and analyze the retained earnings here. So if we're dealing with the retained earnings, and I'm asking you what the ending balance is at the end of the year, I must want you to analyze these transactions here, this information as it's affected retained earnings for the entire year. So I'm going to look at the beginning balance, the adds, the subtracts, the ending balance, right? What's the beginning balance? Beginning balance, they told me, is 50,000. Good. So I'm going to pick up that 50,000. With me so far? Okay. Now I have to figure out the add is typically net income, right? The add is net income. But if you look at this, this person had revenues. This company had revenues of 70. And if you total up all those expenses, starting with that 45,000 and adding through to that 2,000, their expenses are 75,500. Can that happen? Can a company have expenses more than revenues? Let's hope it doesn't happen to you, but it happens to companies, right? So this company has a loss for the period, don't they? So since they have a loss, that's going to be actually a subtract from the retained earnings, right? Oops, I wrote it in the wrong place there because I want to put my numbers there. So that's actually not net income, but that is a, what do we call it? When it's negative, that's a loss of 5,500. We're reducing the retained earnings. Remember, retained earnings, the usual balance is a credit, isn't it? And what happens? If my expenses are more than my revenues, then my debits on the income statement are more than my credits on the income statement, aren't they? Right? So that results in a debit balance of my for my net income of 5,500. And then what? Did they pay any dividends? It'd be kind of weird, in my opinion, to pay a dividend in a year in which you suffered a loss. I mean, people are going to say, hey, that's okay, hang on to the cash. It looks like you're having a little trouble right now. Okay? But in this case, they went ahead and paid a dividend for some weird reason, and we end up with what, 34,500 after we pay out that ridiculous dividend in a year when we had a loss? Yes, sir?
Would it be wrong if I put 5,500 with the 10,000? Because it's subtracting anyway.
Would it be wrong if you did that on your calculator?
No.
Would it be wrong if you did it where? In the middle of the street somewhere? I mean, what do you mean? Would it be wrong if you did it? Would it be wrong if you did it where?
So instead of adding and then writing loss and then subtracting 5,500, if I could just put that 5,500 in the subtraction next to 10,000 and add those two up and write 15,500.
And again, I ask you, would it be wrong if you did it where? On a financial statement somewhere? Yes, sir.
Like how you're sectioning it, so you have like 50,000 on top of the 5,500 next to the A, 10,000 next to the S. He's saying if you section that.
I understand that, but I'm trying to understand, where does he want to do this? On his scratch paper? During the test? Huh? Huh?
Right where you did it.
On the test? Would I mark you wrong if if the answer was B and I ran the Scantron through the machine and it marked it correct? Then it wouldn't be wrong. Okay. I'm not sure where we're thinking we're going to do this. Okay. No, I don't care about the work. If you put it in your, like I say, if you put it in your calculator like that, I'm fine. Okay. The reason I'm asking this question, I know I'm being a little bit of an ass about it, but I'm doing it on purpose because I want you to understand. So I'm not being an ass by accident. It's on purpose that I'm being, okay? Okay, so what I'm talking about is on your statement of retained earnings, okay? This is why I'm asking this. On the statement of retained earnings, we have to present it a certain way. So it would be beginning balance. Beginning balance is 50,000, right? Okay, so we're talking about a presentation of a financial statement, right? Then we'd have to show what? Add net income. Net income, in this case, we'd say subtract loss. On our statement of retained earnings, we'd say what? Subtract, or thank you. I'd say less loss. How much is my loss? 5,500, right? Less dividends. And the dividends are what? 10,000? And then that would give me balance at 12/31, whatever year it is. Whatever year this was when we were doing this, 13. The balance would be then the 34,500. Okay, that's the proper presentation on the statement of retained earnings, right? So that this is my income statement that they showed you up here. So remember, we showed how we flow from the income statement to the statement of retained earnings, and then the dividends come out of the statement of retained earnings. They're not reported on the income statement, right? So when you say, would it matter in terms of me checking work on your test and seeing if you did it that way, I don't care. But in terms of matter of presentation for our financial statement reporting purposes, this is the way you do it, right? Okay. Okay, good. Come over. Oh, just when we were having fun. Okay. All right, so that's pretty much Chapter 2's quiz, okay? And what we're going to do now is try to get through, we should be able to get through the slides for Chapter 3. I'm thinking we may even be able to start the homework, the quiz for Chapter 3. And then I'm going to get you jump started on that. And then probably what's going to have to happen because of our time, you're going to go ahead and finish the Chapter 3 quiz, and we'll start it next time, and that's on Monday. We'll be back to regular schedule on Monday to come back and pick up with the quiz. We'll do Chapter 4. No, that's it, right? So at that point, we'll start our after we go through the slides for Chapter 3, and we'll finish the quiz. We're going to do that today. We'll do the quiz for Chapter 3, and I guess we just start our midterm prep at that point, don't we? And that's all we're going to do from this point forward. And what I'm going to start to do is load more quizzes like this, and now sort of practice midterms on Canvas, and we'll just keep doing it like this. And at some point, the spotlight's going to be on you. I'm going to say, okay, come on up and show me how to do this one, and we'll do it that way, and that'll get us ready. When's the test? October 5th? October 5th? Okay. So that's what? We have all next week. Is that what it is? And then the test on that next Monday after that, or Wednesday? The next Wednesday after that? Okay, perfect. I think we're in good shape. All right? Okay, so let's go ahead then, and let's look at the... Can I close this now? Yeah? Okay. I'm not going to save that because you can see it, and I'm going to go ahead and get us into the slides for Chapter 3. Again, guys, very important slide, right? You're getting why I'm saying that now, right? That this is what it's all about right here. Okay, but I want to go ahead and take us to the slides for Chapter 3. That is class slides. That is Chapter 3. And let's go ahead and go from the beginning. Okay? All right. Now, whether you realize it or not, sorry, let me put this in my bag. Whether you realized it or not, all of this time you have been learning accrual accounting. I didn't put that name on it, but that's what it was. Or maybe I did, I don't remember. But this has been accrual accounting. With accrual accounting, what happens? We don't worry about the cash in terms of recognizing a revenue, recognizing an expense. It's what? For the revenue, we've already provided the service. That's what got us to recognize the revenue. Remember that Sebastian Bella had already provided the service and she wasn't getting the cash yet, but she still put up the revenue and she recognized the receivable. For the expenses, we don't worry about when we pay the cash. We worry if the expense has been incurred, right? And if the expense has been incurred, we go ahead and make the journal entry for that. So you say, well, when were we studying that? That in-class example where we went through year 1 and year 2, all of that was already showing you full accrual accounting as we went through and practiced with that. So if you understand that example plus that one slide, you're going to be in good shape for the test, right? Okay, so but let's just go ahead through and see how they lay this out in the chapter slides. We are not practicing cash basis of accounting in here. Cash basis of accounting says, hey, I'll take a transaction when the cash actually goes in or comes out. That's not how we do it. Okay, in accrual accounting, what happened? We will go ahead and set up and if we pay an expense in advance, we'll call that prepaid expenses, and we will go ahead and debit an asset, for example, prepaid insurance of $1,200, and if the policy is good for 2 years, we'll carry that as an asset as we slowly use up that insurance coverage, right? Okay, it's an asset because it has future economic benefit. So what I want to do for this, I forgot, I want to stay out of slideshow mode for this because this particular transaction should sound familiar to you right here, in which what? Remember in year 2, we had been driving the vehicle without the insurance coverage, and we said, oh, we better get some insurance coverage, so we debited the prepaid asset, insurance coverage, $1,200. We credited the cash, $1,200. We haven't incurred the expense yet. Even though we paid the cash, we don't take the expense yet because we still have 2 years of insurance coverage coming, don't we? Okay, so what do? We go ahead and then remember a little bit later, we got to the end of the year and we said, well, we've used this insurance coverage now. This thing's going to fight me to come down. We've used the insurance coverage now for one of the 2 years, haven't we? So we debited the insurance expense, we credited the prepaid, so that now the prepaid shows, that asset shows we have 1 year left of future economic benefit on this, don't we? One more year left of insurance coverage. In our expenses now, we went ahead and debited the insurance expense because 1 year of that has expired, hasn't it? 1 year has expired. Right? So we're sitting here, and now all we're doing in Chapter 3 is putting a name to what we're doing. We took a prepaid expense. We did what? We treated it as an asset, prepaid insurance of $1,200. Policy is good for 2 years. The adjusting entry will be to do what? To take that out of the prepaid insurance and put it into expense as time passes, right? Okay. Unearned revenue. What happens? Cash is received before the services are performed. We just looked at an example of that, didn't we? Froggy got that money in advance and then went ahead and provided the service for $10,000 a month, whatever. Right? So we set that up as an unearned revenue. As we provide the service, we'll take that as revenue. Okay? Accrued revenue for services performed but not yet received. That was that example of that CPA, that Sebastian Bell lady or whatever, who did what? Who set up the receivable and then debited the receivable by debiting accounts receivable and credited the cash, right? Right? Then what? Accrued expenses is when we take the expense even though we haven't paid for that in cash yet. So what happens here? Let's go back to our example here, and I guess it was what? In year, did we ever have an expense before we had the cash? I could have sworn we set up an accounts payable in one of these years. Here it is right here, where we did what? We took the supplies, right? We took supplies. We set up our supplies as an asset, and we hadn't paid the cash yet, right? Hadn't paid the cash yet. We set up a liability. We set up what? A payable, didn't we? We set up a payable. Okay, now in this example, we set up an asset. If this thing was expiring immediately, we would do what? We would simply have to debit expense. Okay, but remember, we went ahead and we did what? We said that at the end of the year, we counted up our supplies and we had only 13,000 left. So if I have 24,000 of supplies and I go ahead and I count and I only have 13,000 left, and I must have used what? I must have used 11,000, right? So to reduce that asset, I credit the asset supplies 11,000. Is my balance 13,000 now? Which is what I want it to be, because that's what I had left, right? I had 24,000 apples. I counted 13,000. I must have ate 11,000, right? How do I subtract how do I reduce an asset? I have to credit it. And now what? Now I can take the expense because 11,000 of those supplies have expired, haven't they? So I can post it over here. Debit expense. Okay. Okay, good. Now I come over and take a look at some of the examples here. Let's see if it'll let me advance this way. Yeah. Okay. So I have what? I have a cash payment before the expense. We've seen some of these. Insurance, right? Supplies. I could pay my rent in advance. I could sit there and, I don't know. Let's say I have a apartment building, not an apartment, yeah, a nice apartment for you in Santana Row. You guys ever been over to Santana Row? Anybody ever been over there? Pretty nice over there, huh? Right, okay, so I'd say, hey, I got an apartment for you in Santana Row, and I'm going to charge you $1,200 rent for the entire year. Anybody interested? And everybody said, oh, okay, what's it like? 5,000 square feet, tip top of everything. You come, let me let you look at the place, and you say, oh, yeah, okay. What's the deal? What's the catch? I say, just give me the cash in advance for the whole year. And you're like, that's it? $1,200? I could have to pay that for a dump, right? For the security deposit or whatever. I'm just making you pay me the $1,200 in advance. So what do? I debit cash for what? $1,200 because you've gone ahead and you have given me that money, haven't you? Okay. I have to credit something. I credit what? Unearned revenue for $1,200 because I haven't earned that yet. That's at the very beginning of the year, isn't it? And that's going to cover for the whole year? Say that's January 1st. What should I do at January 30th? Have I earned any of that revenue January 30th? How much? 1 month or 100 worth, right? Okay. So I'm going to go ahead, debit the unearned for 100 and credit what? Revenue for 100 because I've earned $100 of that now, haven't I? Okay. Now let's look at it from the standpoint of a prepaid expense. Now for you, when you pay me the cash, what are you going to do with the cash? Debit it or credit it when you pay cash? Credit it. Good. You're going to credit cash for $1,200. You have to debit something. What are you going to debit? Do you have a future economic benefit? You got a whole year of living in this real nice place, don't you? That you paid for in advance. So you're going to debit prepaid, just like we had prepaid insurance before. Now it's prepaid rent, isn't it? Because you've prepaid that in advance for $1,200. That's a debit, not a. Ugh. Just want my debits and credits to line up right. That's a credit for $1,200 on the cash and a debit on the prepaid for $1,200. Just trying to write my credit over. All this noise is about me trying to move my credit over, right? For $1,200, right? Okay. What happens after 1 month? Have you used up? Have you expired part of that future economic benefit? You've used 1 month of it, haven't you? So at that point, you'll debit rent expense for 100 and credit what? Credit what? Credit the prepaid rent. Credit the prepaid rent for $100, right? Right? How much is in the prepaid account now? 1,100 is sitting there. I can't write it there. 1,100 is sitting there in the prepaid. There it was. You debited it for 12 when you first made the payment. Okay, so it had a balance of 12. Then what? Then you just credit it for 100 for the first month's worth of activity. So now there's 1,100 left. How many months left do you have on that contract? 11 months left, 100 a month. Don't you love accounting? Someone can immediately look at this financial statement and see, okay, I get it. You prepaid your rent for $1,200, and so far 1 month has gone by, so you've had what? 1 month of that future economic benefit has expired. We have an expense of $100. We've got what? We've got 11 months to go, don't we? Now, they couldn't necessarily get all that detail out of one glance at the financial statements, but that's why we have footnotes that would call out what's going on with the different amounts that we're seeing and explain what's going on with them, right? Okay. Okay, good. Let's go ahead then, and let's take a look at the next slide. Okay. And they're just showing us what we did here in that we had the asset. The asset was, we'll just make it the rent one that we just did. So we had an asset of what? Prepaid rent. And we did what? We credited cash for 12. We debited what? Prepaid for 12. There's that debit balance, 1,200. Unadjusted balance at the beginning of the year, beginning of the month, whatever. Then what? Then 1 month's worth of activity went by. We credited the prepaid. We debited the expense, didn't we? We did the same thing for insurance, only we waited till the end of the year and we did 6 months all at once. Whatever, right? Okay. Okay, good. You come over and take a look at this one now. And we have this situation where they bought some supplies. Okay, they bought supplies of $2,500. And is it supplies or advertising? Advertising. Oh, yeah, it's the advertising agency. But they bought what? They bought supplies of $2,500, and they bought this on account. Okay, and so when we buy something on account, that's telling you that I'm not paying the cash up front, right? Okay, and so what happens? I go ahead and when I buy the supplies, I'm going to debit the supplies account. Where do I want to write that? Can I write up here without it freaking out? Debit supplies for how much? 2,500. Credit what? Accounts payable for 2,500 because I'm going to pay that later, right? This is just like the lemon tree guy where the fertilizer salesman said, hey, pay me later. So I set up the account payable, don't I? For 2,500. Okay. Then what? Then a little bit later, I get to the end of the year and I count and there's only 1,000 of the supplies left. Well, if I had 2,500, right, and I used up, and I count, I should say, and there's only 1,000 left, and I must have used what? Must have used 1,500. Just like if I bought 24,000 of supplies and I counted up and there's only 13,000 left, then I must have used 11, right? Same thing we looked at before. So we debit supplies expense, we credit the supplies 1,500, right? Now if I'm sitting there and if I had teed up my supplies, I would have had 2,500 that I stuck in there, so I'd have a balance of 2,500. And what did I just do? I just credited it for 15. Guys, is that credit for 15 right there? Yep. I just credit for 15. What's the balance? 1,000. How much did I count that I had left? 1,000. Isn't it beautiful? Beautiful system. Isn't it just great? Okay. Okay, good. You come over and you take a look at this next one. And this one, they pay $600 for insurance. And when they pay $600 for insurance, it's to cover how many months? How many years? 1 year. So this is 1 year. So this one is expiring at $50 a month. Ours was expiring at what? It was $1,200 for 1 year. What was it? No, $1,200 for 2 years. $1,200 for 2 years. So that was also $50 a month, wasn't it? So they're just doing it month by month as opposed to what? As opposed to waiting to the end of the year, right? Do I need to go back to our little example with the insurance? You need me to go back to our little example with the insurance? Same thing, right? They paid $1,200. They paid $600 for 1 month. We paid $1,200 for 1 year. We paid $1,200 for 2 years. That's still $50 a month. We just waited till the end of the year. I could do the same exact question. Say, what would it be, at 12/31? Of course, if it was at 12/31, now it's going to be how many months? Count on your fingers for questions like this. All of October, all of November, all of December. 3 months would have gone by, right? 3 months would have gone by? So if 3 months go by at $50 a month, what would this journal entry be? 3 months have gone by. I'm going to debit insurance expense if it's after 3 months that I wait. 1, 2, 3 months right here. That's $150, isn't it? So I would have debited insurance expense 150 and credited what? Credited the prepaid insurance 150. Same exact thing we did before, right? In the little example. Okay. Okay, good. Come over. Let's take a look at depreciation. Okay. And let's just look at this example a little bit differently. I'm not terribly in love with the way they did this example, so I'm going to look at this a little bit differently. Okay. Let's say that I have some equipment. I don't want to do this. I got a better idea. Let's try it this way, see if it works. I'll keep those. So I'll put it right there. New slide. Okay. Put it back in tablet mode. Put it back into slideshow from current slide. Do I have a blank slide? Will it let me write on it? Okay, good. So we might have discovered a new way to have like a whiteboard, huh? Okay, and so what happens? We're sitting here, and let's say that I purchased some equipment. And let's say I purchased that equipment, I don't know, for $500. Okay, what journal entry should I make when I purchase equipment for $500? But pay it for cash, huh? Huh? Credit cash, good, for 500. Do you want me to debit anything? Debit equipment. If you told me to debit something and I ask you, if you told me to credit something and I ask you if you want me to debit something, you say you must debit something, right? Okay. So I have to debit equipment, don't I? Okay. Now, let's say I'm just telling you that this equipment had a $20 salvage value. Okay, so we paid 500 for it, and I'm saying that the salvage value, I'm putting SV there, is 20. So that means that I have a depreciable base of 480. I'm thinking after I'm done using this piece of equipment, I can go ahead and sell it to somebody for 20 bucks, right? Okay, so I have a depreciable base of 480, and let's say I tell you that the equipment has a life of 4 years. That means that I'm going to use up how much per year? $120 good a year of that equipment, right? And when I first show up, let's say it's a bike. And when I first show up on the bike, man, that's a nice bike, right? By the second year, you see me say, man, that bike, remember how nice it was? And by the third year, you're going, what did he do to that bike, right? After time, that bike is going to wear down, isn't it? Okay? And so what happens? We have to record that economic occurrence in accounting, don't we? Okay? So what will we do? In year one, we will go ahead and debit depreciation expense for how much? 120, because what, 1 year of that has gone by, right? We've used up 1 year of that, 1 year has expired. And we will credit AD as accumulated depreciation. I'm just abbreviating that. 120. There's the first year has gone by, right? So if I track my accumulated depreciation over here, accumulated depreciation just got credited 120, right? With me so far? Okay. Now when I show my balance sheet, and I'm going to do my year one balance sheet here, year one balance sheet, notice the equipment, I didn't touch that account. I mean, I set it up at the beginning for 500, so the equipment is still showing 500, but now I have this accumulated depreciation of how much? 120 for that first year. And so the carrying value of that equipment is now what, 380? Hello? The carrying value of that equipment is 380, and that's at the end of year one, isn't it? Okay. Now what happens? In year two, I've used another year of that equipment, haven't I? Another year has gone by. So what I'm going to do, debit depreciation expense for how much? 120. That's showing the second year of expiration of the value, future economic value of that asset. Credit accumulated depreciation, what? 120 again. I put the 120 there. I prepare my balance sheet now for year two, and my balance sheet for year two is going to have equipment of how much did I pay for the equipment? 500 less the accumulated depreciation of thank you. Now it's what? 240. Yeah. Accumulated depreciation of 240 now. And so now the carrying value, I'm just going to put CV because I'm running out of room here. Now the carrying value is what? 260? 260? 260, right? Right? Okay. Okay, good. Now I go into year three. Guys, I don't want to write the same journal entry again 4 times because it's going to look like a mess on here more than it already does. So I'd make that same journal entry in year three, don't I? Year three, I make that same journal entry. And if I prepare the balance sheet again now for year three balance sheet, the equipment is how much? 500. The accumulated depreciation now is what? 360. And the carrying value is now what? 240? 140, I mean? Okay, good. I do that same journal entry again in year four. Please don't make me write it for again, God. Why did I should have become a doctor, right? Why do I have to sit here and write these things over and over and over again? That's what accountants do, right? Okay. And so I go ahead and I do year four. Is it 120 again? So now I prepare the year four balance sheet, and I have equipment of how much? 500. I have accumulated depreciation of how much? 480, and I have a carrying value on this equipment of what? Of $20, which is what I had estimated I could sell it for, right? With me so far? So what happens if somebody walks up to me and says, I can't believe it. You got an actual Schwinn? Is that really a Schwinn? Do you guys know what a Schwinn is? It's a bike. It's a type of bike. Okay. I don't know if they make them anymore. Is that that's a Stingray? I'll give you $50 for it. I love Stingrays, right? And so what happens? When he gives me the cash, and I'm just writing it over here because I see a little open space, I'm going to debit cash for how much? $50 because he gave me the $50. I'm going to sit there and I'm going to credit the equipment. How much was in the equipment account? No. In the equipment account was 500. Look, I never touched the equipment account other than when I bought it, right? Equipment still got 500, but that asset is gone now, isn't it? So I want to take it off the financial statements. I credit equipment for 500, so the equipment's gone, isn't it? Right? I only debited equipment once. If I teed up equipment over here, it only had that one entry when I bought it, which was to debit it for 500, right? And I didn't do another thing to it after that. Right? Okay, so I get rid of the equipment. Now I want to get rid of the accumulated depreciation. Accumulated depreciation has a balance of how much? 480 sitting there, doesn't it? 480 is what's sitting there, and I want to get rid of that, so what do? I debit the accumulated depreciation for 480. Is it gone now? Is it gone now? The accumulated depreciation's gone because I just debited it 480, so that's now 0. And I want to get rid of this accumulated depreciation because I want to get rid of this property, don't I? I'm getting rid of this property. So the equipment's gone. The accumulated depreciation's gone. I got my $50 cash. I'm seeing $530 of debits up here, right? So I need what? I need a $30 credit, don't I? Do I need a $30 credit to make this journal entry bounce? That $30 credit is considered a gain. Did I gain? I gained, didn't I? I sold that equipment for $30 more than its carrying value. I have a gain on the sale. Now, you're saying, well, why don't you just call it revenue? I don't call it revenue because I'm not in the business of selling my equipment. Revenue is normal course of business. We call it revenue if it's my service that I usually provide. If I sell equipment that I use in the delivery of that service, we have a different name for it. We call it a gain, but it's certainly like a revenue, isn't it? Just like a revenue is like a gain. Okay? Now, if I sold this equipment for $10, then I'd have a loss of what? Of $10. Loss is like an expense, but we don't call it expense. We call it a loss. But it's still going to reduce my net income. Okay? Okay. Now, we're not going to get into that level of detail with equipment. Oh, that's a scary looking thing. We're not going to get into that level of discussion of equipment until we get into later chapters. But by the time we get to that now, because of this discussion, you'll be champs, right? You'll be the kings and queens of accumulated depreciation. Okay? Okay. So you take a look at the financial statement presentation. They have the equipment, and this is after 1 year. They have the equipment. The depreciation expense for year 1 was $40, so the accumulated depreciation was what? $40. The difference between the original purchase price of the equipment and the accumulated depreciation. They're calling it book value. Book value, carrying value, guys, are synonymous terms. Book value and carrying value are the same thing. In our example, it was what? The first year, it was, after we took 120, was 380, whatever, after that first year, or whatever it was, and so on. Down, down, down each year. Okay. Book value and what I was calling carrying value. The carrying value was for year 1 was 380 when we took the accumulated depreciation. The book called that book value. I'm calling that carrying value. Both terms are synonymous. I called it carrying value on purpose, just so we would learn a different term than what the book is telling us. Okay? Okay, good. You come over, and unearned revenues, you know how to handle. Unearned revenue, what do? When you first get the cash, you do what? You first get the cash, you debit cash for, what was it, in our little example. Remember the guy came up and he said, hey, show up at we had a gigs or whatever, the DJ thing, and didn't he give me $120,000 up front? And we credited the unearned. I'm just going back to our little example for $120,000. In our little in-class example, $120,000. So we would have had an unadjusted balance of $120,000, right? And then I think in our little example, it was $10,000 a month was what we were going to receive. And he gave us the money on July 1st. And after 6 months, we went ahead and we provided the service. So we did what? We debited the unearned revenue, $60,000, and credited what? Credited revenue, $60,000, didn't we? Same exact thing we did in our example. Right? Do you need me to show you the example again? Okay, good. That's the answer I'm looking for. No, not that example again. If you've got that example down, you got all this down though, don't you? Okay, so make sure you're cool with that example, that you're going through and you understand every little thing that happened there, because I'm taking you all through the process. And if you're stuck on something, you can look at the video of it and you just sit there and fast forward to whatever it is that you're having trouble with, and you can watch me talk about it again and again. And you can put that on an endless loop, right? Put it up on the big screen TV right beside the football game while your friends are watching the game. You can have right by the side the video, right? Okay? Okay, hang on, guys. Okay? And so we go ahead and we debit the unearned service revenue. We credit the service revenues. We've earned the service. Okay, I'll tell you what. We'll pick it up here. Okay, I'll make sure that we've covered everything in these slides. I don't think there's much more to this. Now, you should be able to, even with this discussion having not been completed, you should be able to go ahead and get yourself through the Chapter 3 quiz. We'll start pretty much there next time. We may look at a couple more things from the slides. Chapter 3 will be done, and then we're going to be full into our midterm prep, right? Okay, guys? All right, have a good rest of the day. Appreciate your patience, and we will see you on Monday.
So we should start looking and doing the chapter 3 homework.
Chapter 3, yeah, the quiz that's up there. Yeah. And if you want to do the Chapter 3 Connect homework, if you have that, you can do that. I may put a couple more of the Chapter 3, Chapter 2 Connect questions, those one with all the journal entries and stuff.
Yeah.
So you can look for those too.